Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, I'm going to be reviewing Pacific Life Annuities. Basically, I'd tell you if I'd recommend them or not. Out the gate, I would say, yeah. I mean, Pacific Life is a good company. As you can see here, A+ with AM Best, AA- with S&P Global, AA- Fitch, AA3 with Moody's. Not a bad gig. I mean, this company's strong. Question is, would I recommend their products? So, I've talked about this in a few other videos. Like, just because the annuity company has high rankings doesn't mean their products are any good. Allianz is notorious for that. Their products suck, but it's a fantastic company. So I'm going to kind of like just off the cuff go through this and tell you what I think about it. I don't recommend any of their variable annuities. I'm not a fan of variable annuities in general, frankly, because it's 2 to 3 times in fees. And when you're looking at how much upside ratio compared to downside risk, you're just better off with doing a fixed or fixed index annuity. Oh, well, better off with doing a fixed index annuity specifically. So if you're looking for like lifetime, so if you're getting an annuity and you're wanting that lifetime income, right? You want that insurance that's going to guarantee that even if the account runs down to zero, you're going to get the same or better payout for the rest of your life or the rest of you and your spouse's life. There's no reason for you to be paying 3 to 4% a year of your account's value when you could be paying 1%, 1.25%, right? To get the same or better outcome. So in terms of growth, I typically recommend if you're going to go, if you want the upside potential and you're okay with the risk, just go be in the market, man. Being in a variable annuity is not worth the 3, 4, 5% in fees that are going to come out of your account each and every year when you could just cut that down to a fraction. So, and I think a lot of like the YouTubers out there that talk about annuities, that talk trash about annuities, I think a lot of times they're either referring to a variable annuity because of the hefty fees, or they're referring to a SPIA, which requires you to give up control of your money. And we're not fans of either of those, but they're never talking about the good stuff. The good stuff in the annuity world is the fixed and fixed index annuities. So they got variable annuities, don't recommend. Register index-linked annuities. I think this is kind of a gimmick. These are a fairly new type of annuity. It's if variable annuities and fixed index annuities had a baby, you're able to get more upside, quote unquote, more upside. But you're able to lose money up to a certain point before the protection comes in. I just think you could buy a fixed index annuity and you could just pay for more upside. And then this way you have 100% downside risk and you can get similar upside as a real annuity and not worry about the hassle of losing money, right? So I'm going to go in here. They've got several different types of annuities. I'm going to go to fixed annuities. They're all different versions. Pacific Index Advisory, this is for fee-based advisors. I personally and professionally don't agree with fee-based annuities. The reason being is, and just for the record, or just for context, there are 2 types of annuities in terms of revenue to the financial professional. There's commission-based annuities, which most annuities are commission-based, and then there's fee-based annuities. Well, annuities don't need managing, right? If you're paying a fee out of your pocket in a good or bad market to a financial professional for an annuity or for the amount of your portfolio in an annuity, I think you're getting ripped off because the annuities manage themselves. Outside of a variable annuity, you have principal protection up to a certain point, right? You're not moving money around. You're not paying attention to the indices each and every year. You're literally once a year changing the allocations and spending less than 1 hour of your time. And if somebody's charging you a fee, let's say it's 1% management fee each and every year, you're actually paying more out of pocket, good or bad market, than you are with the commission annuity. Over a 10-year lifespan of an annuity contract, you're paying 10% more in fees, good or bad market, as opposed to 5 to 7% commission from the insurance company. and the outcome is similar to each other. So you're in this position where I ran into this person on chat a week ago. They had a fee-based MYGA. And if for any of those that don't know, a fee-based MYGA is like a CD where you pick out a fixed term, you get a fixed interest rate, you get that fixed interest rate for that fixed term, and then you're charging a fee for the same outcome as a commission-based MYGA, and there's no higher interest rate than a commission-based MYGA. To me, that's a ripoff. To me, that's a scam, right? So in general, you should not be paying fees to advisors for any sort of annuity outside of a variable annuity. Even with a RILA annuity, yes, you can lose money up to a certain point. There's some sort of principal protection, right? It's a click of the button. There's when you're managing money, you're looking at different investments, how the investments are going to do, what you're predicting, what you're projecting. Okay, so there's merit to earn a fee there, right? And a fee is just another word for a commission. Okay, so if any of you haters out there are like, oh, this is coming from a commission monger annuity salesman, it's not. A fee is actually worse for the consumer's financial for their bottom line when it comes to annuities than it is a commission-based annuity. And if you compared apples to apples, you would see that a commission-based is better. The other thing is fees can be changed. People can, you go to a grocery store or a service that you provide, have fees gone up because of inflation? Well, a financial advisor can say that too, So it's just, there's a lot of room for error and nefarious behavior for a product that self-manages itself, right? It's like paying a Roomba to vacuum your house. So I don't agree with fee-based annuities. And I think they're ripoffs, and I think they need to go back to commission-based, frankly, because they're doing little to no work for a product that manages themselves, and it's more money out of your pocket. So going back to this, they have all these different types of versions. I'm not going to go over each and every one. It's a good company. Here's what you need to really be looking at. Number one, if you're looking for lifetime income or guaranteed income, start with the income first and work your way backwards, right? So that means go compare to several different companies. And look, you don't have to contact somebody. You can come to our website and you can go to our annuity calculator and you can just plug in your information and you can find out what the annuity payouts are anonymously. Don't put your email in. Just see. So if somebody pitches you a Pacific Life annuity, find out what that guaranteed income amount is, what the dollar amount is. So, hey, I want to start my lifetime income in 2 years. Okay, so starting year 3, just come in here, plug in your information. Start after 3 years. It'll show you what it is in year 3. And then you'll know what those payouts are. Okay. So start there and work your way backwards. Finding a highly rated insurance company is easy. It's trying to get the most income as possible, right? That's the name of the game. If you go to upside potential, so I would go to the rates, and that you could go to their, you could just Google what the rates are, or you can contact a financial professional like the Annuity Expert to do that. And you can look down here what the rates are. So here's a 10% buffer. That means you can lose up to 10% before the principal protection comes in. Performance mix, I'd stay away from this. When we recommend annuities for growth, we use the KISS method, keep it simple, stupid method. Okay, what that means is stick with indexes that are on the daily news. Okay, which are the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average. So when I'm looking at this, I'm looking at the S&P 500. So if I look at, so they have a 6-year term. So this means that they're going to look at it. You're going to get 105% participation rate with the S&P 500 over 6 years. The problem with the 6-year term is you don't get any interest credited for 6 years. Okay, so let me be dramatic. If you get into this annuity, you pick out this strategy, you're not going to see really a dime credited to your account after 6 years. So if you have 6 years and it doesn't perform better than today, and by the way, we're still at an all-time high with the S&P 500. So if you buy this annuity today, 6 years from now, so May 12th, 2032, the value of the S&P 500 needs to be higher than today's value. You will get 105% of that. Okay, it's not a bad gig. The question is, will the S&P 500 be higher in 6 years from today? And if it isn't, that's a big fat zero. So going 6 years without earning interest, I'm not a fan of that. I'm a fan of 1 year terms, 2 years max. The analogy I use when it comes to earning interest in any of these annuities is it's like I use baseball, right? Every time you have a reset period, 1 year term, 6 year term, that's the amount of times that you're at bat. And when you get up at bat, you're either going to hit a home run or you're going to strike out. You're not going to get a base hit. It's one or the other. Home run, strike out. You earn interest, that's a home run. You don't earn interest, that's a strikeout, right? And so you're putting yourself in a position where, like, in a 6 year term, you get like one shot, maybe two, right? Depending on how long you want to be in that annuity contract. My gut tells me if you go 6 years and you don't earn any interest, you're getting the hell out of that annuity pretty quickly. So I'm going to say one term, right? In that six year term, that 1 year term strategy, you're going to get 6 opportunities to earn interest or not earn interest. Okay. And I think that's a good gig. Like, I think that's S&P 500, NASDAQ 100, Dow Jones Industrial Average, 1 year terms. All right. And here you get a cap rate, and it depends on what your buffer is. So a 10% buffer, remember, you can lose up to 10% in a RILA, but you get a 16.5% cap. That's not a bad gig. If you have a 15% buffer, 12, a negative 10% floor, 11%. Here's the problem. There's a new trend in annuities, the index annuities. Index annuities include fixed index annuities and RILA annuities. Is that a lot of these contracts are doing one or two things. Number one, they're going 6 years. So 6 years, you don't touch it for 6 years, you don't really earn interest. Now, you're going to see it have the ability, you'll be able to track what the growth is of the 6 years, but you're not really getting that vested interest for 6 years, okay? Then what annuity companies are doing now here in 2026 is they're giving these rate locks, cap rates, participation rates, spreads. They're going to be locked in for the entirety of the contract. So this can be changed on an annual basis. So this year it might be 16.50%. Next year they may drop it down to 8. Next year they may drop it down to 3. I know this because I personally own 3 fixed index annuities. And I'll tell you, with my American Equity fixed index annuity, I was getting no cap with the S&P 500 at 55% participation rate up until this year. This year it went from 55% participation rate down to 25% participation. I mean, I got cut at the knees, almost half, right? So more than half. So these are things that you can avoid when buying an annuity in 2026. Is why would you take the risk of losing money? Something that's guaranteed. This 10% buffered, you are guaranteed that you can lose this amount of money each and every year, but the 16.50% isn't guaranteed as a cap each and every year. So why would you put yourself in a position? You're putting yourself at the mercy of the insurance company to not change your cap rate each and every year, but guarantee a percentage of loss that you can have, right? So what I recommend is going with an annuity where it has a 1 year, maybe a 2 year term, no more than that, and the caps or the participation rates are locked in for the entirety of the contract. So in a perfect world, this 16.50% would be locked in each and every year for the entirety of the contract. Looking at this, it's not. Okay. I'd stay away from this index. 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 These are all mutated versions of other indexes. This right here, the iShares Russell 2000 ETF, it's just a mutated version, an engineered version of the Russell 2000. Just if you like the Russell 2000, just go with the Russell 2000. Don't meddle with this. S&P 500, same here. So all these, this is, if I were to recommend, if I were to ever recommend a Pacific Life annuity, it would be primarily for lifetime income. If they had a product that would generate the highest income for a person's scenario, I would recommend them because they are a financially strong company. I like them as a company. But if somebody were to say, hey, Shawn, I'm looking for safe growth, this would not be the company. I just wouldn't do it. Frankly, because of, hey, we have the contractual guarantee of loss, but with the RILA annuity, or even with a fixed index annuity, but the caps and the participation rates could change on an annual basis. The other reason why I wouldn't recommend them is the only index I would choose, is the S&P 500. If I'm going down here, I would not recommend this. I would not recommend this. I would not recommend this, right? You ever heard of this? You ever heard of the First Trust Growth Strength Net Fee Index? I haven't. Why would I bother to learn about it? It's probably not going to be around in the next 5 years, right? And then you're going to end up, and I created an annuity, or excuse me, a video about, hey, what do I do if my annuity is a lemon? I just don't get yourself in a position where you don't understand a product inside and out, right? So it's the S&P 500 wave. That was it. So I don't have anywhere where I can pivot and kind of bob and weave through different market trends. Like for me, a perfect annuity, and it's not out there. They had one about 10 years ago where one annuity had, you could be in the S&P 500, you could be in the NASDAQ 100, you could be in the Dow Jones, real estate, not industrial average, but real estate. That's not a bad index. Okay. Gold. Right. So when is gold great? When everybody else is, when the stock market's volatile, gold's doing great. Right. So I could do gold. They had an S&P 500 performance inversion index where if the S&P 500 tanked and you were in that index, you would get like 8% credited to your account. So anyways, for lifetime income, I would recommend this company if the lifetime income was like in the top 3 highest paying income for your scenario. If this was for growth, move on to another company. If you got any questions about this, let me know. Leave a comment below. I'll answer it in the next couple of days. I know this was a little long-winded. This is kind of like my second or third annuity review, and so I'm kind of winging it. Everything that I record is off the cuff. I hope this helped in some capacity. If you got questions, visit us at the Annuity Expert, and we'll help you out. No cost, no obligation. See ya.